when something's kind of forgotten and given up on and it's been dormant for years, which it has, usually it'll rise from the ashes and become a leader. Right now, I'm bullish on gold. I think gold is going to have another big run. I actually just got out of Bitcoin as today, as you and I are speaking.
Okay, guys, so today we have Chris Vermeulen from technicaltraders.com. And today we will talk about what's happening with the economy right now with the recent numbers. And we will talk about commodities, any other interesting sectors, as well as portfolio structure in the current environment. So Chris, thank you very much for being here.
Hey, thanks for having me, Vladislav. Appreciate it.
Thank you very much, Chris. So we have a lot of news, a lot of economic data right now. So what's your take, Chris, on what's happening right now with the US economy?
My take on the U.S. economy, I think it's. I mean, when we look at from the stock market, you'd think nothing is wrong. We see stocks continuing to push to all-time highs. I think a lot of that is heavy lifted with the Magnificent Seven stocks just grinding their way up, or you could actually say they're kind of rallying their way up. They're the crowded, play. Everybody wants to be in on those. They don't want to miss out. FOMO is the most powerful, one of the most powerful things in the stock market, and when people don't know what to buy, but they want to buy in, they buy whatever's in the news and whatever everybody else says they own, right? So that's the Magnificent Seven. So it's dragging the markets up. But when we look at the markets, the overall economy, I think things are getting pretty like starting to slow down. You know, things are ridiculously expensive. We're starting to see, jobs are starting to struggle. We're seeing weakness in the housing market. Homes aren't turning over. People don't want to sell their house because they feel like they have to drop the price dramatically to sell it. And then they're also worried if they get a new house, they're going to need to pay this crazy high mortgage. A lot of people are kind of stuck in their house because they got low, cheap rates years ago. And if they move, they're going to pay double, triple the mortgage rates, which makes a smaller house cost the same as their big one. So everybody's kind of stuck in this market, various markets. And I think the music's coming to an end at some point, but you can't fight the trend. If the stocks are going higher or precious metals are going higher, you really have to stick with that until they actually do turn a corner. Even though everything is screaming like stock market's going to collapse and all of that, you can't trade on what you think or feel. You actually have to follow the price and trade with it.
Certainly. And so, Chris, does it look similar to you? So right now it looks like the mainstream are trying to use every single opportunity to buy the lows, to buy the dips. If we're talking about S&P 500, the markets, they're looking for an opportunity to buy. Does it look similar to 99 to early 2000s too?
Yeah, I would say it looks very similar to 2007. When you look at the price of what the S&P 500 has been doing, which is hitting all-time highs, and now it's pushing to, made all-time highs early this year. Now it's pushing back up to all-time highs again. Gold is outperforming. It's a top performer long term. It's getting a lot of attention. It's got some of the strongest gains. The dollar is the most hated currency. All three of those are happening at the exact same time in chart patterns as what we saw in 2007. So there's always a different reason why we go into a financial crisis. And I know people will say, well, this is nothing like 2007. And that's true. 2007, 2008 bear market was nothing like the tech bubble. But the same thing happens with assets. When people get scared and bad things happen, it doesn't matter what the reason, they sell stocks. And we see everything sell off. So people always get caught up in the news and what's causing it. And they always say, well, this time's different. But when you look at it from a price chart, it's not different. It's markets are all-time highs, and eventually we're going to have fear and selling, and the markets go down. The same it's done every financial reset. So it doesn't really matter what the heck people are bailing and running from in the markets. It's they're selling, and that's the same result that you get is falling pricing. So yeah, I think we have a very unique setup. In fact, the setup we have right now is signaling that the dollar should start to find a bottom and that gold is on the verge of a big rally. It's on the verge of about a 20 to like 35, 37% rally, sending it dramatic, like higher into the mid 4,000 range. So we're definitely at some exciting times. And during this phase, the stock market might still hold up and move a little bit higher. And really, you just have to follow the markets. But we're definitely nearing, I think, a critical turning point in a bunch of asset classes.
Mm. So you mentioned gold, Chris, and so gold performed really well. But also, if we look at what's happening with the deglobalization, with everything, it looks like gold has a lot more upside in the future because usually when the economy goes bad, yeah, sure, at the start, gold usually drops down as well, but then gold is usually one of the best performers. So, what's your take, Chris, on gold for the next 6 to 12 months and then maybe for the longer term as well? Would you be bullish at the current levels?
Yeah, right now I'm bullish on gold. I think gold is going to have another big run. I think something bad is about to hit the markets. That's what gold is telling us. When you look at the price action of gold, it's saying something's wrong. Investors are nervous. I like gold because it's a global barometer, it's a global trade. Whereas if you look at silver or mining stocks, they're more of like a North American speculative trade. So I think in this market situation, gold has more upside over the next 1 to 2 months than other things like silver or miners. Um, Longer term, gold will hold up better than everything else than silver and miners if we're kind of comparing those, if the market and when the market goes into a recession. But longer term, silver at the start of a new bull market, so maybe 6, 8, 12 months from now, say the market's reset, silver will get hit very hard. It's very volatile, but it will actually have the most upside, I think, when the market turns around and starts a new bull market. So right now, where we're in a real fear-driven market and things are unstable, gold, I think, is the better play. But once we have a reset, then I think silver and miners are actually the play, and that's the way I've traded in the past. Is focus on where the low risk, high return is, which is gold, physical gold right now. And then when you get into a bull market, the high return, high risk is actually in the more risky stuff, the stocks and silver, because they can really scream and rip to the upside. I call them golden rockets when the time comes. You just hop in and they just take off.
100%. And if you look historically as well, that's exactly what happens. Money sort of trickles down from the commodity and then down the chain. And just with miners, Chris, so even at the current levels from the fundamental perspective, the miners are doing really well, especially the big companies like Newmont, Agnico, they're printing cash. So there's definitely a lot of fuel if what you believe happens and the price of the actual commodity goes up, the stocks have like unbelievable upside.
They do. And when gold shoots up, some of these companies are going to have some massive profit margins. So that's one of the reasons why I think they'll do so well once I mean, they are coming to life right now. We're starting to see gold miners and silver miners start to outperform gold a little bit, which is a good short-term bullish sign. But yeah, when the time comes, when the money flows are really, when the whole world's starting to pile into the mining space, then I mean, they're going to go ballistic. And there's hundreds or thousands of percent return in a lot of these individual stocks. You just have to wait for that perfect environment. And I know a lot of people are thinking now is the time and gold's going to rally for many, many years right now. I do think gold's going to rally, but I do think we're going to go through some type of economic reset and gold will probably struggle and so will silver and miners. But after that reset is when I think the real opportunity for the miners are going to come to life. And you're right, as price of gold goes up, the profit margins for some of these go up like hundreds of percent just because they're very leveraged and yeah, it's gonna be pretty exciting for a lot of these companies. I like when I get into the mining stocks, I like the royalty companies a lot. The companies that actually don't do the work, they just own the properties and they license it out. And so all these other companies come in, they spend all the money on labor and fuel and machines and digging and processing. And then the people who own the property are just like, yeah, we just take our cut. You guys take all the risk. We'll just take a piece of the profits if you turn some.
Hmm. And so I had a lot of guests recently that they are very optimistic on silver for 2025 by the end of this year. So how does silver look from the technical perspective, in your opinion, Chris, right now?
Yeah, I think silver could rally with gold over the next month or two. It's got potential. For some reason, the chart doesn't show it having a ton of upside potential. Silver has a very messy chart. It always has. I've never been a big fan of charting silver because it's all over the place. It's always got these sloppy technical chart patterns that kind of negate each other and they give you these false, really, it's really hard to kind of predict where it's going. But generally, it follows the price of gold. It's big brother or big sister, whatever you want to call it. So if gold's going higher, we should see silver naturally go up. People naturally think silver, moves much faster, so they want to get into silver versus gold. It's not always the case, but I think we'll see silver move higher. It doesn't have the clean chart pattern like gold, where it's showing like 20 to 40%, in the next 1 to 2 months. Silver is a really messy chart. It's really only showing like 8 or 10% upside based on the chart patterns I have. So I'd much rather move to something that has more upside potential, clearly, than something that's a little bit messier at this point.
That makes sense. But if you look at the big picture, that cup on hand from 1980, that looks fantastic as well, which also makes sense. If gold performs, then silver usually follows it. And then when it breaks the 50 level, we could see some fireworks as well. But that's, of course, that's going
Yeah.
to take some time.
Yeah, for
Okay.
sure. That's a 45-year pattern. It's that could take another 5 years to unfold. Like that's a huge, huge time frame. It looks good. Long term, it's pointing to much, much higher pricing. Silver, like 80 or 100 or $250 silver. But just because it has that potential down the road doesn't always mean it's the time to get involved right away.
And Chris, would there be any other commodities that you would be interested in right now? Maybe copper, uranium?
Not so much. I'm not a fan of copper. Copper has definitely been really volatile. It's hitting all-time highs not that long ago, based on tariffs. Tariffs like created a lot of noise in that space, and copper prices shot through the roof. And then, of course, they just dropped and collapsed about 20%. So it's a really ugly chart, a lot of volatility. If anything, I'm more or less a little bit, I think, bearish on copper. Platinum and Palladium, they've had a pretty nice run. They have volatile chart patterns. I'm pretty bearish on those as well. They've kind of topped out from what it looks like, and they formed a bearish pattern, meaning a pattern that is pointing to more selling. So I don't think I think there's limited upside in those. You're really kind of to get long, you're buying them in a downtrend, and trends are more likely to continue than they are to reverse. So if it's in a downtrend, you're best not to buy it because it's most likely going to continue to go down. That's the point of a trend. So I think gold is the play. I do think the dollar eventually is going to firm up and become a very good play late this year or early next year. I think if the economy goes through a recession, we're going to see the dollar index start to move higher. Of course, that'll mean probably gold is pulling back and the equities markets are falling. So I do like that as a potential play. And potentially bonds could become a play over the next several months. They're still in a downtrend. They're still trying to figure out if they've found a bottom or not. But bonds could become a good play. They're one of the most beat up, out of favor. And when something's kind of forgotten and given up on and it's been dormant for years, which it has, usually it'll rise from the ashes and become a leader, right? So the biggest dog becomes the leader at some point, and that's how the markets just kind of rotate. So there's a few things I'm keeping my eyes on, but these are all big picture, stepping way back. All these take months and months to unfold. So that's kind of the big high level view there.
Thanks for that. So you partially answered my next question as well, but I do like to ask this question about portfolio structure in the current environment. So
Mhm.
what are the things that you think about, Chris, when you do structure portfolio? What would be the things that you pay particular attention to?
Yeah, the biggest thing, I'm a believer of only holding asset classes that are going higher. I don't want to hold something if it's going sideways or it's going down. That's not what we do as investors. We don't buy stuff to watch them go down. We want them to go up in value. So I have a way using technical analysis to identify if something is in a strong enough trend to say, okay, we want to own it, or it's not strong enough or going down. We'll be like, let's just avoid it for now. We'll just buy it later when it shows positive signs. So in this market environment, which I think carries a ton of risk, we have about 40% of our portfolio in cash at the moment. We're long equities. I mean, you can't fight this trend. The trend is up, and you've got to just be, riding the market higher. Eventually, we'll scale out of the equities position and we'll look for a play potentially in the dollar or bonds, or maybe sit on the sidelines. And we could get into gold with a little position if it starts to break out. It hasn't quite broken out yet. I kind of want to wait for that to take place. I know a lot of people are getting into gold now, anticipating the rally. I kind of play it a little differently. I wait, I buy it on the breakout. and so that you get an imminent move. Because what happens is a lot of people bought gold like 2 months ago and it's gone nowhere. It's sideways. So that money's been wasted when you could have been in stocks making money. And so if gold starts to take off, it probably means actually the stock market's starting to roll over. So we would move out of stocks and potentially roll some money into gold. And when gold breaks out, it's a beautiful chart pattern. It should rocket higher, which means like pretty much the day we get in or the week we get in, it's just going to keep going up and up and up. And so our money's working right away versus waiting for a pattern that might unfold. I wait for it to unfold and then jump on the bandwagon.
Yes, it's a very active strategy, but it definitely makes sense in the current environment with all the chaos that's happening, with all the volatility. Makes a lot of sense. So, Chris, what's your thoughts on natural gas and oil?
Yeah, natural gas and oil. If we take a look at natural gas, I mean, natural gas has just been pretty beat up. I think it goes through this huge 4 year cycle, and it's just gone through a big, massive peak in price. And I mean, based on the chart patterns, I think it's going to go back down to about $2 for natural gas. I think its trajectory is looking kind of weak for a little while. Oil, I'm not a fan of either. I think it's in a downtrend. It's pointing to about 50, 56, $57 a barrel as the next support level. And I think I mean, oil to me is a good barometer of how the economy is going. I think we've seen a lot of shipping, a lot of products, a lot of things are coming to a halt. A lot of people have paused orders because of tariffs. And there's not a huge increase in demand or any increase in demand for oil, yet they're producing more oil. So it's not a good sign. I think the energy space is going to struggle for a while and move lower.
And do you get involved with the crypto sector at all?
A little bit. I mean, we've done a couple trades in Bitcoin. That's about it. It's the only one that I really track and follow. We put on a trade last year for about a very quick trade, it was about 40% return. It was a beautiful multi like using the monthly chart, a huge explosive move. We trade Bitcoin a couple months ago for a quick 20% move. We actually just got out of Bitcoin as today, as you and I are speaking, locked in some gains on Bitcoin. So we do play it a little bit with one of our strategies, and using just the ETF IBIT is the symbol for that. But it's not the bread and butter. The focus is what the stock indices are doing, bonds and currency, cash. Those are the four biggest asset classes. It's like, do people own stocks, bonds, or cash? And we rotate between those, our large portfolio. And we do these occasional little side, what I call discretionary trades. Hey, Bitcoin's got a nice little setup. Let's play it for a quick move because it's a crowded play. When it breaks out, it moves quickly. We make our money, we get out. And so that's what we do with a few, some side trades to stay active, if we want.
Yes, that makes total sense. So, Chris, I like to ask this question for the younger audience. So, with everything that's happening right now, we could have a young individual who wants to get involved in this wealth building path. But he has so many choices with the crypto, with Nvidias, with the commodities. What advice would you have for that individual when they're still very early and at the start of their wealth building path and have so many different choices?
Yeah, that's a tough one. I mean, I've always been very conservative in what I do. I don't swing for the fences. I mean, I've done it before and it's always backfired. So I've blown up like three different trading accounts when I started trying to do that. Like, how can I make this small account big fast? Generally, that backfires. You might hit a few and do well for a couple of years, but eventually there's going to be one that wipes you out. If you do it and you make some good money with one or two of those, it's super hard to do, but you got to step back and be like, okay, now I need to protect my money. So I'm all about compounding the growth, taking lower risk trades that have a high probability of winning. So, for example, the way I do things and manage my portfolio is very different than everyone else. Most people chase the shiny stocks that are everything is moving. It's in the news. They're fast moving because they want to make a lot of money. Um, I do the opposite. So instead of taking these fast volatile moves, which carry a ton of risk, which means you can only put a small amount of money to work of your portfolio, because if it backfires, you're going to blow up your portfolio. So you have to find a whole bunch of these really explosive moves. and manage them all, which is very difficult. 97% of active traders lose money over the long run. So most people just are set to fail no matter what. I do it the opposite way. I focus on how can I put my portfolio into these low risk trades where I make 1, 3, 8, 15% here and there consistently, win most of the trades, and my entire portfolio goes into those. And so we grow it. And so, for example, instead of taking like 50 or 100 volatile trades and random stocks and sectors and stuff and juggling them all, and it's a nightmare in reality. What I do is I take 5 to 12 trades a year, buying the stock indice or a bond play or a currency play, and I'm just looking for these small, high probability wins. And Albert Einstein said the most powerful force in the universe is compounding. So instead of having these huge trades and big wins, but on tiny positions and gambling with all that, I'm like, I'm just going to take 5 to 12 of these small little trades. And each time I close one, I roll the money into the next trade. So I compound my small gains or my controlled gains 5 to 12 times a year, which actually gives us the returns of a aggressive trader who had a good year without having to take the risk. So that's what I focus on. And it just uses ETFs, and we trade the slowest indices. We trade the NASDAQ, the S&P 500, and the bond ETF, and we can get performance that most people wish they could get. And we don't really have a whole lot of downside because the way we grow our account. So it's that to answer your question, a young person, you kind of have to be aggressive to kind of get some account size going. But once you hit some type of level that you're comfortable with, could be 10 grand, could be 20 grand, whatever, 50 grand, that's quite a good size trading account. Then I think you should just focus on the long term of having a consistent strategy, compounding it, and knowing that you're not going to have a year that's going to wipe you out because you're using a strategy that manages risk. And just be like, if I was to do this every year for the next 25, 30 years, you're going to have way more money than everyone else by playing it safe, but compounding your safe trades over and over again, multiple times a year.
Yeah, I fully agree. The position size is so important, and most people don't realize that if you make one mistake, so if you're disciplined all throughout the whole year, but then
Yeah.
you decide to go, put 15, 20, 30% of your portfolio, and if that goes against you, that could wipe out most of your gains for the whole year,
Yeah.
which is why it's
Uh,
so important to.
Yeah, it's one of the biggest problems. People don't look at risk. They look at something that's moving fast and like, oh, I want to get in on that trade. And they pull a number out of their hat. Say their account is like, say, $50,000. They're going to be like, you know what, I'm going to dump 30 grand into this. It looks like a quick trade. I'm going to make some big money. And then the thing like backfires and drops 10 or 15% overnight or over the next couple of days, and their account is like devastated, and they're like, wow, that, they did. A lot of people will say, I didn't realize there was that much risk. And really, that's just the lack of common sense. Like, it's crazy. All you have to do is go back on the chart, look at a daily chart, and go back, look at the percentage rally and percentage sell-offs over the last 1 or 2 years on it. On average, they're always going to be about the same. They'll be, depending on the volatility. This, we had somebody who talked about what is the solar, the clean tech PBW is the clean tech ETF. Somebody got into it and it pulled back like 8%, and they were shocked how much damage it did to their account, and they didn't realize it was that volatile. I'm like, all you have to do is go back the last year and you'll see every sell-off was like 8 to 15%. And every rally was about 8 to 15%. So you have to be able to stomach that, right? But people don't do the most basic and simple analysis. They just jump in because they're excited. And it drives me nuts that people have zero risk management, zero, position sizing. They just pick a number out of the hat and take it. And that's why most people lose. It's just they don't put in the effort. People are they don't understand, or they're lazy, or both, and they just chase the money versus focus on protecting their capital and growing it in a safer way.
For sure, for sure. And Chris, what would be the best advice that you have personally received that had the biggest influence on your investing trading career when you were younger and less experienced?
Oh, that's a good one. I mean, I've blown up 3 trading accounts. I have lived through a bankruptcy. I know what it's like to be at the top of the food chain and then go right to the bottom. Uh, I got my POTS license when I was 16 years old, and I learned all about checklists. And it doesn't matter if a flap or something breaks on the plane and it's smoking or flapping around, and you're like, oh my gosh, if you follow the checklist, a proven strategy that's strapped to your leg, like on as you're flying, believe it or not, you can fly a plane with a ton of damage, with no engine working or one engine working or a flap jammed or something, right? It's amazing if you just when you start to panic or you get emotional like in the markets, just you follow a strategy, right? So I learned at a very young age, create strategies, create rules. And so I built trading strategies at a young age. And through that and through losses and bankruptcy and blowing up accounts, you're like, okay, I need to really focus on not only on just how the strategy makes money, but how can the strategy avoid losses and multiple losses and stuff. So I think the key for most people is don't wing it. Don't just pick a trade that you hear about or a chart looks really good. Um, Write down, document. I actually have like a little 3 hour course that I sell. It's trading system mastery. It's like take the idea that's in your head, and in 3 hours, if you follow the guide, you'll document it. And through the process of documenting and making sure you have everything done, you realize you actually don't have a strategy. You thought it was, and you thought it was winning, but when you actually write it down and run the scenarios, you're like, this actually is a net losing strategy. And through that process, you build something up. And the goal is to create a strategy that works and have it documented where I could go to like a fifth grader or somebody who's never traded and say, here are the rules, follow this strategy, and they should be able to make money. It should be that documented. And eventually, when you become good enough, you end up having like 10 or 12 of these little trades, individual trading strategies that doesn't matter what the market condition is. You're like, today or this market condition, I use this strategy and this strategy. And when the market changes direction or something, then I use these strategies. And you just follow them, right? And you need a strategy to manage your strategies. This sounds crazy, but some strategies work in a bullish environment. Some of them work in a falling environment. Some of them work in a sideways or high volatility or low volatility. So you also have to manage which strategies and identify which one to use. But everybody uses what they think is like they just buy stocks or buy it and they think the market conditions are the same, which they're never the same. You do need to evolve. The markets are living and breathing. So you need multiple strategies. You need to know when to use them. You need to know when to adjust position sizing during a high volatility or risky environment, like kind of like what we're in now, where I think there's at any point the hammer could drop and things could fall. You should be more defensive, smaller position sizing, smaller targets to the upside. You want to hit a target quickly and sell some of that position and lock in the profits and move your stop up. But people just really just take a random approach and they say, I'm going to buy this and here's my target. I'm all in, I'm all out. Trading is not easy. And most people don't even have a plan, which is why they fail.
That's a very good one. Thanks for that, Chris. And I try to do something similar with investing as well. When I analyze the company, I try to write things that can go wrong, that can kill me, the
Yeah.
things that I think are going to go right, and then I sort of fight between the two and try to find consensus. But simple things like writing down stuff, I think it helps you so much. So
Mhm.
that's a very good one. Thanks for that, Chris. So, Chris, these are all the questions I had. Is there anything else that you believe it's important that maybe we haven't mentioned, something that you particularly pay attention to? Could be anything at all.
Yeah, I mean, this goes against the grain for everyone else because everybody gets into markets to make money and to make a lot and to hopefully make it fast. But that's not the reality. It's the wrong expectations that people come into the markets with, and that's what backfires. Typically, when the markets start to sell off and volatility shoots up, it's like the stock market becomes like those bluey purple bug zapper lights. When volatility gets big and things are moving fast, it like lures in the novice traders who think that they can make quick money even quicker. And that's like the worst thing. My whole strategy, when things get volatile, we actually move back. We move to slower and slower assets, and sometimes we just move to cash. When things get noisy and volatile, that's when there's more risk, right? So don't get too excited when things are volatile. Wait for the volatility to end and a new trend to start. I think the other thing to think about is, do you really want to trade individual stocks? They carry a ton of risk. They move very fast. A lot of them have liquidity issues, which is also one reason why sometimes they move very quickly. I like ETFs. I used to only trade penny stocks and small caps, and then I migrated into day trading for many years. I ran a futures day trading chat room for many years, and I've slowly evolved to just trading ETFs. I like the stock indices, bonds, currency, the biggest asset classes there are. They're big, slow moving waves and tides. And that's where I focus on moving my money into because I can move all my money into the stock indice when it's bullish. And when it starts to show signs of weakening, I trim off profits or I step out and I move to something else. But if you got stocks, you really have to have a whole portfolio of them and then manage them all because you can't put your money all in one stock. And I like to just be able to move in and move out within seconds using an ETF. Liquidity is not a problem. And it just keeps it really simple.
And I think ETFs, they follow the technicals better as well, just because of the size. It's difficult to move them, so they appreciate the cup and handle or whatever pattern you may see. So that
Yeah.
totally makes sense.
Yeah.
So Chris, again, these are all the questions I had. I really enjoyed your conversation, your perspective. So thanks for that. And I hope to have you back, sir.
Thanks for having me, Vlad. Appreciate it.